Today, we're not going to talk about strategies, indicators, or the latest hot tips. We're going to talk about something much deeper. The psychology of winning trades, specifically in the UK market, where unique time zones, volatility patterns, and trader mindsets often make the difference between success and failure. Trading isn't just numbers on a screen, it's a battle with your own emotions. Fear, greed, impatience. These are the enemies, and if you want to win consistently in the UK market, you must master them. Let's break this down. Point 1T, discipline over impulse. When we talk about the psychology of winning trades in the UK market, everything begins with one word: discipline. Discipline is the invisible line that separates amateurs from professionals. In fact, I'd argue that discipline is the only true edge in trading. The UK market, particularly during the London session, is famous for being the most liquid and volatile trading window in the world. At 8:00 a.m. London time, trillions of pounds worth of currency, commodities, and indices come alive. It's at this exact moment that traders face their first test. Will they act with discipline, or will they get swept up in the storm of impulses? The trap of impulse in the London session. Let's paint the picture. You've just opened your trading platform. The pound against the dollar spikes upward as the market opens. News headlines are buzzing, traders on Twitter are screaming, and the charts are moving like wild horses. Most beginners, and even many who call themselves experienced, cannot resist. Their finger hovers over the buy button. They think, I don't want to miss this move. That feeling of missing out, also called FOMO, fear of missing out, is the greatest weapon the market uses against you. And in the London session, it strikes hardest. But what often happens next? That spike reverses. The trader who entered impulsively is now trapped in a losing position. They panic, close at a loss, and then watch as the market finally sets up properly. The very move they could have captured if they had just waited with discipline. Why discipline matters more in the UK market. The UK trading window is not like Asia, where moves are smaller and calmer. Nor is it exactly like New York, where volatility often comes later in the day. London is unique because it combines high liquidity with unpredictable bursts of price action. That means the temptation to act impulsively is greater here than anywhere else. Traders see sudden moves and feel like they must act, but discipline is what prevents you from gambling. Discipline forces you to say, no trade is better than a bad trade. My setup hasn't appeared yet, so I wait. Even though the market is moving fast, I will only act when my rules are triggered. Winning traders in the UK market understand that opportunity is endless but capital is limited. Impulsive traders think every moment is an opportunity. Disciplined traders know that most moments are traps. The psychology of waiting. One of the hardest things to do in trading is nothing. Human beings are wired to act. Our brains evolved to hunt, chase, and grab opportunities the moment we saw them. That was useful when survival depended on catching food. But in trading, that same instinct destroys accounts. Discipline is training your brain to be comfortable with waiting. It's reminding yourself, the market opens every day. If I miss one move, another will come. My job is not to trade everything. My job is to trade only what fits my plan. In the UK market, patience is the weapon of the strong. The London Open will always create noise, but behind that noise there is always structure. If you wait with discipline, you allow the fake moves to trap the impulsive traders while you prepare to catch the real move. Case study example: GBP USD at the London Open. Consider this. The Bank of England is set to release an interest rate statement later in the week. On Monday morning, GBP USD spikes up aggressively at 8 a.m. Traders without discipline see that candle and think, this must be the beginning of the week's trend. They jump in. Within 30 minutes, price collapses, wiping out their stop loss or, worse, forcing them to hold a losing position. The disciplined trader, however, waits. They've reviewed their plan. They know that without confirmation, the spike is just noise. Later in the session, when liquidity stabilizes and a clear breakout forms on higher volume, the disciplined trader enters. Their trade works not because they had a crystal ball, but because they had the discipline to wait for confirmation instead of chasing the first flashy move. Building discipline as a habit now. How do you build this discipline? It doesn't happen overnight. Just like a muscle, discipline grows through repetition. Here are some practical steps for UK traders. Have a written plan. If your rules are only in your head, impulse will rewrite them in the heat of the moment. Write them down: entry conditions, risk levels, maximum trades per day. Stick to them like law. Limit screen time. Staring at the chart every second makes you hypersensitive to noise. Set alert levels and step away until price reaches your zone. Journal every trade after every session. Write, did I follow my plan? Did I act with discipline? Or did I react with impulse? This reflection makes you accountable to yourself. Set maximum daily loss limits. Discipline isn't just about entries. It's about knowing when to stop. A daily loss cap protects you from revenge trading, which is the ultimate form of impulse. Train patience in small ways. Practice waiting in everyday life. Whether it's resisting checking your phone or delaying gratification, you're rewiring your brain for patience, and that patience will carry over to trading. Discipline over impulse. A winning identity. The ultimate shift comes when discipline becomes your identity. When you no longer say, I try to be disciplined, but instead, I am a disciplined trader. In the UK market, the traders who last, the ones who grow accounts, the ones who eventually trade professionally, are not the ones who chase every move. They are the ones who wait, observe, and only strike when everything aligns. Impulse may feel exciting, but it's the silent killer of trading careers. Discipline feels boring, but it's the foundation of every winning trade. So remember, in the psychology of winning trades, especially in the UK market, discipline is your edge. Impulse is your enemy. Point 20. Patience is a position. If discipline is the foundation of winning trades in the UK market, then patience is the structure that stands on top of it. Many traders think patience is passive, as if waiting means you're doing nothing. But in reality, patience itself is a position. Choosing to wait is as strategic as choosing to buy or sell. The illusion of constant opportunity. One of the biggest traps in the UK trading scene is the illusion that every flicker of the chart is an opportunity. The London session, being the most active globally, feeds this illusion. Price whipsaws up and down, candles form quickly, and the inexperienced trader feels like they must always be in the game. But here's the truth: most of those moves are noise. They're market makers testing liquidity, algos probing weak hands, or reactions to small news items that will fade in minutes. Jumping into every flicker is like running after every bus you see on the street. You'll be exhausted, and you'll probably end up going in the wrong direction. Patience, on the other hand, is stepping back and saying, not every candle is my candle, not every move deserves my capital. If I wait, the real move will show itself. Why patience pays in the UK market. The UK market is unique because of its structure. The London Open collides with Asian session leftovers, then flows into the US overlap in the afternoon. This means that a large portion of early moves are simply liquidity grabs. The big banks and institutions that dominate the London session use these hours to trap impatient retail traders. For example, GBP USD may spike 30 pips upward at the open, pulling in impatient buyers. Then, just as quickly, it dumps 50 pips in the opposite direction, hunting their stops. Who wins here? The institutions who patiently engineered the trap, not the trader who couldn't wait. Patience protects you from being the liquidity. Patience puts you on the side of the hunters, not the hunted. The psychology of waiting. Pain versus power. Let's be honest, waiting feels painful. Watching the market move without you creates tension in your body. Your brain whispers, what if this is the big one? What if you miss out? This fear of missing out is hardwired into us. It's an evolutionary instinct. But here's where successful traders flip the script. They don't see waiting as painful. They see waiting as powerful. When you wait, you're sending a signal to yourself, I control the trade doesn't control me. I decide when I engage. The market doesn't force me. Every tick that passes without me jumping in makes me stronger. This is the psychological shift. Patience is not weakness. It's strength. Real life example: gold in the UK market. Imagine you're watching gold at 8:30 a.m. London time. Price has already spiked during Asia, and as London volume hits, it's moving aggressively up and down. The impatient trader buys immediately. They're stopped out. They sell the next move. Stopped out again. They repeat this cycle until frustration wipes their account. The patient trader, however, waits. They mark out key levels on the chart: yesterday's high, major support, psychological round numbers. They know that real moves form when price breaks these levels with confirmation, not during the random whipsaws before. They wait for the market to come to their level. Hours later, price finally reaches a major resistance zone and rejects strongly. The patient trader enters, executes with confidence, and catches the clean move. The impatient trader has already lost 3 trades and the will to continue. Same market, same opportunity, but only one had the patience to win. How to train patience as a trader? Patience is not something you decide once and instantly master. It's a habit you train every day. Here are methods UK traders can use to build patience like a muscle. Predefine your setups. Write down exactly what a valid trade looks like: time frame, structure, entry signal, risk conditions. If your setup hasn't appeared, you simply cannot trade. Use alerts. Let technology work for you. Set alerts on key levels and step away from the screen. This reduces the temptation to jump at meaningless moves. Practice observation sessions. Dedicate entire trading days to watching without trading. Study how the UK market sets traps, how liquidity behaves, how moves evolve. This rewires your brain to see waiting as valuable learning, not wasted time. Reward patience, not action. In your trading journal, don't just review trades. Review the times you chose not to trade because your setup wasn't there. Celebrate those moments as wins. Control impulses outside of trading. Small habits in life reflect in trading. Resist checking your phone constantly. Delay unnecessary purchases, or practice meditation. The same self-control carries into your trading patience. The long-term power of patience. Here's the reality: the UK market will always be there. It opens every day, it moves every day, and opportunities flow endlessly. But your capital won't survive endless impulsive decisions. Patience is what allows your account to live long enough to see the big opportunities. 1 or 2 disciplined, patient trades a week can make more profit than 10 impulsive ones a day. Professionals know this. They don't measure success by how often they trade, but by how well they wait. Think of it like this: hunters in the wild don't fire arrows at every rustle in the bushes. They wait for the clear shot. Traders who win in the UK market think the same way. Final thoughts on patience as a position. Patience is not absence. Patience is presence. It is an active choice to protect your capital, to wait for the highest probability setups, and to align yourself with the flow of the market rather than fighting against it. In the UK market, where volatility can trick you into believing you must act right now, the trader who can say, "Not yet," is the one who wins in the long run. So remember this: when you wait with patience, you are already positioned. Not in the market, but in your mind. And that position is stronger than any impulsive entry you could take. Point 3a: controlling greed. If discipline protects you from impulse, and patience keeps you from rushing, then controlling greed is what allows you to keep your profits once you've earned them. Greed is subtle. It whispers, just a little more. Hold on longer. Double the position. Take one more trade. And in the UK market, where volatility can swing profits into losses in seconds, unchecked greed destroys traders faster than any technical mistake. Greed, the hidden enemy. Most traders think fear is their biggest enemy. They fear losing money, fear missing trades, fear being wrong. But in truth, greed is often deadlier than fear. Fear makes you hesitate. Greed pushes you into reckless action. Fear may keep you out of a trade, but greed will keep you in too long. Fear makes you cut winners early, but greed makes you add to losers, hoping they'll turn around. In the UK market, this plays out every single day. Traders catch a good move during the London session. They're already in profit. But instead of following their plan and closing at their target, Greed tells them, ride it longer. The market might give you more. Within minutes, volatility reverses and their winning trade collapses into a losing one. The lesson? In trading, it's not just about making money, it's about keeping it. And keeping it requires controlling greed. The UK market's greed trap. Why is greed such a powerful trap in the UK market? Because London is the world's liquidity hub. Moves often extend further than expected. A breakout might run for 40 pips, 60 pips, sometimes 100 pips in a matter of minutes. This tempts traders into believing the move will never end. They stop respecting their targets. They start imagining life changing profits if they just let it run. But the UK market is also known for its brutal reversals. A sharp profit can vanish in seconds. This is why professional traders say, pigs get slaughtered. The greedy trader always believes there's more. The disciplined trader takes their share and steps aside. The psychology of enough. The word enough is the antidote to greed. But most traders don't define what enough means. If you don't set a profit target before the trade, your brain will invent one in the middle of the move. And that invented number will always be more than what you already have. Let's say your plan was to take 40 pips. You reach 40, but greed whispers, you're up 40, why not 60? At 60, it whispers again, why not 80? Eventually, the move reverses, and you're left with 10 or even a loss. A winning trader in the UK market doesn't fall for this. They know their numbers. They know their setups. They have already decided what enough looks like before they even enter. Once that level is reached, they exit, no second guessing, no negotiating with greed. Example, FTSE 100-day trade. Imagine trading the FTSE 100 index at the London Open. Price breaks above a resistance level and runs 50 points. Your plan says take 40 points. At 40, you're up nicely. But you see price climbing further. Greed whispers, stay in, this could be 100 points. You ignore your plan. By the time you decide to close, price has snapped back violently, leaving you with only 10 points. The difference wasn't the market. It was your psychology. The disciplined trader took their 40 and walked away. The greedy trader walked away angry, even though they technically won. This is why controlling greed is not about charts. It's about mindset. Practical ways to control greed. Controlling greed requires structure and self-awareness. Here are strategies that top UK traders use. Set take profit targets in advance. Decide your exit before entering the trade. Place your target order and let the market hit it. This removes emotion from the decision. Use scaling out. Take partial profits at logical levels. For example, close half your position at 40 pips, then trail the rest with a stop. This satisfies your desire to let it run while protecting what you've already made. Journal emotional triggers after each trade. Ask, when did greed show up? Was it when you saw profits? Was it after a news headline? By recognizing patterns, you can anticipate when greed will attack. Daily profit goals. Just as you set daily risk limits, set profit goals. Once you've hit your target for the day, step away. Overtrading after reaching goals is almost always greed disguised as discipline. Detach from money. Don't stare at the cash value of profits on your platform. Focus on pips, points, or percentages. Thinking in money terms activates emotions faster and fuels greed. The long-term view. The real danger of greed is not a single bad trade. It's the erosion of consistency. You can have 9 good trades, but one greedy mistake can wipe them all out. Over time, greed destroys confidence, making you hesitant and emotional in future trades. Winning traders in the UK market understand this. Consistency beats occasional brilliance. They'd rather take steady, repeated profits than swing for home runs that risk blowing the account. Patience brings you to the opportunity. Discipline gets you in the trade. But controlling greed is what keeps your account growing. Closing thoughts on greed. The hardest sentence a trader can learn to say is, that's enough. In the UK market, where volatility constantly tempts you to hold longer, take one more trade, or chase another pip, controlling greed is the difference between temporary success and lasting success. So train yourself to take what you planned, walk away satisfied, and protect your consistency. Because at the end of the day, The market doesn't care about how much you want. It only rewards those who know when enough is truly enough. Point 48. Handling fear of loss. If greed pushes you to risk too much, fear of loss holds you back from taking the opportunities you should seize. It's one of the most destructive emotions in trading. Not because it makes you lose money directly, but because it paralyzes you and prevents you from executing your edge. In the UK market, where volatility is sharp and news events can shake prices in seconds, fear is magnified. If you don't learn to handle it, you'll always trade like a prisoner of your emotions rather than the commander of your capital. Understanding fear of loss. Fear in trading is primal. It comes from the same survival instinct that kept our ancestors alive in dangerous environments. Losing money feels like losing safety. That's why your heart races, your palms sweat, and your mind panics when a trade moves against you. But here's the paradox in the UK market. Fear of loss doesn't prevent losses. It creates them. Fear makes you exit too early. Fear makes you avoid trades that fit your strategy. Fear makes you second-guess your analysis. Fear makes you shrink your position sizes so small that you never grow. Ultimately, fear convinces you that you can avoid pain in trading. But the truth is no one can. Losses are part of the game. The only question is whether you control the fear or let the fear control you. How fear shows up in the UK market. Fear takes on special forms in the London session. Fear of the open at 8 a.m. When London opens, spreads tighten, and price jumps aggressively. Many traders see the volatility but are too afraid to enter. They wait until the move has already happened. By the time they act, they're chasing. Fear around news. The Bank of England's rate decisions, inflation numbers, or GDP releases are some of the most anticipated global events. Traders fear the spike and hesitate, then watch as the market runs in the very direction they predicted. Fear after a loss. A trader takes one losing trade in the morning. Instead of resetting, they carry fear into the next setups. They hesitate, miss entries, or enter late. By the afternoon, they've watched multiple winning trades slip away. The common thread is that fear of loss doesn't save you from losses. It only guarantees missed opportunities. The psychology of loss acceptance. The solution is not to eliminate fear. That's impossible. The solution is to accept loss as a cost of doing business. Just as a shopkeeper accepts that some stock will go unsold, traders must accept that some trades will be losers. Think of it this way: your edge is not about winning every trade. Even the best strategies in the UK market win only 55% to 65% of the time. Your survival depends on how you manage the losing ones. Fear of loss is only dangerous if it makes you avoid executing your edge. When you fully accept that losses are normal, fear loses its grip. Case study: GBP USD after a Bank of England release. Let's say the Bank of England holds interest rates steady. The pound spikes up briefly, then falls hard. The fearful trader thought about shorting but froze. They said, "What if it spikes higher? What if I'm wrong?" They watch the move pass. Later, regret fuels revenge trading, and they lose even more. The confident trader, however, already knew their risk. They planned for both scenarios. They entered the short with a stop in place. The market moved in their favor. Even if it hadn't, they would have taken the small, controlled loss and moved on. The difference: one trader accepted the possibility of loss and executed. The other let fear dictate their actions. How to handle fear of loss in practice? Here are actionable steps for UK traders. Define risk before entry. Fear is uncertainty. When you don't know how much you can lose, your brain panics. By setting a stop loss before entry, you give your mind certainty. This is the maximum I can lose. Normalize small losses. Take losses as data, not disasters. Review them in your journal. Was it part of the plan or a mistake? If it was part of the plan, it's a cost of business. If it was a mistake, it's a lesson. Trade smaller to train confidence. If fear dominates, reduce your position size. Trade so small that you can execute without panic. Once your confidence grows, slowly scale up. Detach from individual outcomes. Judge your performance not trade by trade, but over 20, 50, or 100 trades. A single loss is meaningless in the context of your overall edge. Practice visualization before trading. Imagine yourself losing a trade calmly. Picture yourself accepting it, recording it in your journal, and moving on. This mental rehearsal reduces the emotional shock when it actually happens. The long-term mindset. The truth is simple: fear of loss is permanent unless you shift your relationship with risk. The most successful UK traders are not fearless. They simply respect risk and embrace it. They know that losses are tuition fees paid to the market. If you fear losing 100, you'll never make 1,000. If you can't risk a small drawdown, you'll never experience large growth. The irony is that when you stop fearing losses, you actually reduce them. Why? Because fear causes mistakes, while calm execution protects your edge. Final thoughts on fear of loss. Fear of loss is a shadow that follows every trader into the market. But remember, the market doesn't punish you for losing. It punishes you for avoiding execution and sabotaging your edge. The UK market is fast, volatile, and often unpredictable. If you freeze at every spike, you'll always be a spectator, never a participant. The solution is not to seek safety in every trade, but to accept risk, define it, and move forward with confidence. So here's the takeaway: don't fight fear, reframe it. Accept that losing is part of winning. Because in trading, those who fear loss most lose the most. Those who accept loss win in the end. Point 50. Building confidence through routine. Confidence is the fuel that powers disciplined and patient trading. But here's the truth: confidence is not born from winning trades. It is built from consistent routines. Many traders in the UK market look for confidence in outcomes. They believe if they just win a few more trades, they'll finally feel confident. But real confidence doesn't come after a win, it comes before. It's the steady belief in your process, no matter what the market does. And the only way to build that belief is through routine. Why confidence matters in the UK market. The London session is brutal for unprepared traders. Price can explode 40 pips in minutes, then reverse just as fast. Without confidence, you hesitate. You second-guess your plan. You enter late, exit too soon, or avoid good trades altogether. Confidence allows you to execute your edge in the middle of chaos. When others are panicking, you remain calm because you trust the process you've repeated every day. And in the UK market, where volatility is normal and uncertainty is constant, confidence isn't a luxury, it's survival. Routine. The secret to confidence: ask any professional in sports, the military, or trading, and they'll tell you the same thing. Confidence is built on repetition. It's not about hype or motivation. It's about muscle memory. The footballer practices free kicks until it's automatic. The soldier trains drills until he reacts without hesitation. The trader develops a daily routine so decisions become habits, not guesses. Your routine is your foundation. It transforms uncertainty into structure. And in the UK market, where unpredictability reigns, structure gives you certainty. Elements of a winning trader's routine: pre-market preparation. Confidence begins before the market opens. Successful UK traders don't roll out of bed at 7:55 a.m. and start trading at 8. They prepare. They review economic calendars, mark key support and resistance levels, and identify potential setups. By the time the London bell rings, they already know what they're looking for. This preparation removes doubt and builds confidence. Set trading hours. Routine means you don't chase the market at random times. The UK session is most active between 8 a.m. and noon, then again during the New York overlap. A confident trader has fixed trading windows. They know when they work and when they step away. Defined entry criteria. Confidence is not, "I feel good about this trade." It's, "My conditions are met, therefore I enter." Your routine should define exactly what a valid setup looks like. Timeframe pattern, confirmation signal. When the conditions align, you execute without hesitation. Risk management rituals before every trade. Routine means calculating position size, setting a stop loss, and deciding on profit targets. This removes fear because you know exactly what you risk. No guessing, no improvisation. End of day review. Confidence is reinforced by reflection. At the end of each session, review your trades. Did you follow the plan? Did you act with discipline? Confidence doesn't come from whether you won or lost. It comes from knowing you followed your rules. Example, the routine of a UK Forex trader. Let's take a trader who specializes in GBP USD during the London session. At 7:00 a.m., they wake up, check the economic calendar, and note any high-impact news. At 7:30 a.m., they mark support, resistance, and prepare trade scenarios. At 8:00 a.m., as London opens, they sit calmly, not chasing the first spike, but waiting for their defined setup. At 9:15 a.m., a breakout forms with confirmation. They enter risk pre-defined, target set. They execute without hesitation because the setup matches their plan. At noon, they stop trading regardless of results. They journal trades, reflect, and close the platform. Day after day, this routine builds confidence, not because every trade is a winner, but because every action follows structure. The psychology of confidence through routine. Why does routine create confidence? Because it replaces uncertainty with predictability. Your brain no longer wastes energy asking, "What should I do?" You already know, you've practiced. When traders lack a routine, every decision feels like a guess. Guessing breeds fear. Fear breeds hesitation. Hesitation breeds inconsistency. But with a routine, decisions feel automatic. Automatic execution feels safe. Safety builds confidence. Practical steps to build your routine. Write it down. Don't keep your routine in your head. Document it step by step. This makes it concrete and harder to abandon. Start small. Don't try to build a perfect routine overnight. Begin with one habit, maybe journaling or pre-market prep, and expand. Protect it like a ritual. Treat your routine as sacred. Don't skip it because you feel lazy or overconfident. Consistency is what makes the routine powerful. Review and refine every month. Review your routine. Keep what works. Remove what doesn't. A routine is a living system, not a rigid prison. Long-term benefits of routine. Driven confidence over time. Traders with routines become unshakable. Losses don't scare them because they know they followed the plan. Wins don't inflate their egos because they know one trade doesn't define them. Confidence through routine creates emotional neutrality. You stop riding the highs of wins and the lows of losses. You become steady, consistent, and professional. And in the UK market, where emotional traders get wiped out daily, neutrality is the ultimate edge. Closing thoughts on confidence and routine. Confidence is not magic. It's not motivational quotes or hype music. It's not feeling lucky. It's the quiet certainty that comes from repeating a process until it becomes second nature. In the UK market, volatility will always test you. Spikes will tempt you. Reversals will scare you. But if you have a routine, you have an anchor. You can face the storm with calm execution. So remember this: confidence isn't built in the market. It's built in your routine before you even enter the market. Point 6: emotional recovery after a loss. Every trader loses. That's not an opinion. It's a fact of trading. Even the best professionals in London, New York, or Tokyo face losing days, weeks, and sometimes even months. But the difference between traders who survive and those who quit is not whether they lose, but how they recover after a loss. Losses in the UK market can feel especially brutal. The London session is fast, liquid, and volatile. You can be up 40 pips 1 minute, then stopped out the next. One bad trade at the open, and your emotions are shaken for the rest of the day. The challenge isn't just financial, it's psychological. And learning to recover emotionally after a loss is one of the most important skills in the psychology of winning trades. The emotional impact of loss. When traders lose, they don't just lose money, they lose confidence. They feel frustration, anger, and even shame. Some traders become reckless. They enter revenge trades, trying to make back what they lost. Others become paralyzed. They stop trading altogether, too afraid to pull the trigger again. Some swing between both extremes, hesitant one moment, reckless the next. None of these responses build long-term success. Why? Because they all come from being emotionally hijacked by the loss. Why recovery matters more than winning. The truth is simple: every trader will face setbacks. But if you don't recover quickly, one bad day turns into a bad week, then a bad month, and soon a blown account. Think of it this way: winning traders don't avoid emotional pain. They shorten its duration. They cut the emotional bleeding quickly so they can get back to trading with clarity. In the UK market, where opportunities appear daily, the faster you recover, the faster you return to execution. Common UK market scenarios of emotional strain, false breakouts at the open. You enter what looks like a perfect breakout at AC 10 a.m. price spikes, then whips back and stops you out. The frustration feels worse because it happened so fast. News whipsaw as the Bank of England announces something unexpected. Your trade moves into profit, then instantly reverses. You feel cheated, as if the market took your money. Death by 1,000 cuts instead of one big loss. You take 3 or 4 small ones in a row. Now your patience is gone, and you're tempted to quit or gamble. All these scenarios create the same problem. Negative emotion takes over. Recovery is the only way forward. The process of emotional recovery: pause and step away the moment you take a loss. Resist the urge to trade again immediately. Stand up, walk away from the screen, and give your nervous system time to reset. In the UK session, even a 10-minute break can clear your head. Reframe the loss. Instead of saying, "I failed," say, "This was tuition." Every loss is data. If it was part of your plan, it's the cost of doing business. If it was a mistake, it's feedback for improvement. Either way, it's valuable. Review objectively. Write in your trading journal, "Did I follow my rules? Did I break discipline? Was this loss avoidable or just part of probability?" Separating emotion from analysis is key to recovery. Control the spiral. Set daily loss limits. If you hit your max loss, stop for the day. This prevents one bad trade from turning into 10. Protecting your account protects your psychology. Reset before the next trade. Before you re-enter the market, take a breath and ask, "Am I calm? Am I following my plan? Or am I reacting emotionally?" If you're not calm, you're not ready. Example, a trader's emotional recovery. Let's imagine a trader in London trading GBP USD. At the open, they lose 30 pips on a false breakout. Frustration boils. They want to hit, sell, again immediately. But instead, they close the platform, take a walk, and make tea. After 15 minutes, they review the loss in their journal. They realize it wasn't a mistake. Their setup simply failed this time. That's part of the game. With calm restored, they return later in the session. A valid setup appears. They enter with discipline, catch a clean 50-pip move, and end the day positive. The difference wasn't luck, it was recovery. Building emotional resilience over time. Recovery after a loss isn't just about one bad trade. It's about building resilience so losses never derail your long-term growth. Daily reset. Treat every trading day as a fresh slate. Yesterday's loss doesn't belong in today's mind. Physical health. Exercise, sleep, and nutrition directly affect emotional resilience. A tired, stressed trader can't recover well. Community support. Share your struggles with other traders. Talking reduces the weight of losses. Isolation magnifies it. Practice acceptance. Remind yourself daily, losses are normal. The more you normalize them, the less power they hold. The long-term view on losses. Think of your trading career as a marathon. Along the way, there will be stumbles and falls. If you stop every time you fall, you'll never finish. The winners are those who get back up quickly, dust themselves off, and keep running. In the UK market, the ability to recover emotionally is just as important as any technical skill. Because in the end, consistency isn't about avoiding losses, it's about how fast you come back after them. Final thoughts on recovery. The market will always test you. It will humble you. It will hit you when you least expect it. But remember, your strength as a trader is not measured by how many wins you collect, but by how quickly you recover from your losses. Losses are not the end. They're a reset. They're an opportunity to refine, rebuild, and return stronger. The UK market rewards resilience. And if you master emotional recovery, no single trade will ever have the power to define your future. Conclusion. So let's put it all together. Discipline keeps you from impulsive traps. Patience allows you to wait for the real move. Controlling greed helps you protect your profits. Handling fear lets you trade with calm execution. Routine builds unshakable confidence. Recovery keeps you consistent even after setbacks. This is the psychology of winning trades in the UK market. Strategies will change. Indicators will fail. News will surprise. But psychology, that's eternal. Remember this, the market is not your opponent. You are your opponent. Master yourself, and the UK market will reward you. Thank you.